Hello. Welcome to episode number 7, Market Analysis. This is Value Investor TV podcast. My name is Beko and Hari. Welcome, everybody. Thank you for joining us. Today, we're going to talk about market analysis. In the last several episodes, we've so far talked about companies, analyzing their competitive advantage. We talked about thinking like an owner, which is a very important process as an investor. We looked at different types of competitive advantage, starting from switching cost, network effect, all the way to IP, high-cost infrastructures, as well as lowest cost providers. Now, today in this episode, we want to talk about the marketplace that these companies play in. If you think about internet industries, if you think about different types of industries are very different in nature. But overall, we can kind of classify them in 3 different buckets: growth, steady, and declining. And we want to touch on that and how that affects our thinking process. And also, we also want to talk about life cycle of a business. Business go through a life cycle, just like any organism out there, from birth to all the way to decline and sometimes death. In companies, and actually most times death. So we'll talk about that in this episode. Welcome, you guys. Okay, so let's just dive right into different markets. As I said earlier, 3 different types of market industries, largely defined. And there are different ways to look at them depending on what type of industries companies belong to. So let's start with growth industry. So Hari, if you could tell us more about growth industry and how companies play in that industry, and as an investor, how we should look at those growth industry companies.
Yeah, so growth is more, the industries that are in growth are, what you would think of, tend to be newer players, newer industries like tech, e-commerce, Twitch, like live streaming, that kind of stuff. So these things appear, and there are lots of competition, lots of players show up in that space. And then what happens is, they all fight for control of that space. So, people probably forget, there was Uber, there was Lyft, and then there was Sidecar. A Sidecar, was early on, with all these other players. Uber and Lyft kind of took off. Sidecar just, wasn't also ran in that space. So these industries that start out, there's a lot of, blue sky, basically. Everybody is a potential customer at that point, and you can start growing. And so that means that there's a long runway for these companies to play in, because it hasn't been touched yet, as far as. So, think about it from the perspective of 15, 16 years ago. E-commerce was, is only 1% of, all of retail. Even today, it's only, 15 to 20%. So it hasn't even penetrated 100, even 50% of retail. But all people talk about is e-commerce and how everything is sold online and so on. One of the side effects of these growth industries is that's where a lot of the press is. That's where a lot of people focus on as investors. And these companies tend to get a premium in terms of price because people are interested in, the hot commodity at the time. And so, you compare that to a steady industry, you'd think about companies like banks. Almost everybody in the country has a bank account. Really the only people who don't have bank accounts are, kids who then, get older. So, and that's also replaced by people who die and, they shut their bank accounts and, and so on. So what you see is there isn't a lot of growth in those places. There may be newer players that come along. Right. There may be declining businesses in that space, but for the most part, the overall market for this is growing, not much faster than GDP or even, less than, the growth rate of the entire economy.
Yeah, I just want to clarify one thing for our listeners. So we Hari talked about growth industry as a industry where, it's booming. It's a blue sky, blue ocean, long runway, and press is on it. People talk about, e-commerce, cloud computing as a new frontier, as this long runway that people all can play in, and therefore they get a premium. And therefore they get a huge competition. It's a very it's a very competitive space if you're in a growth industry. And as we pivoted from growth industry and we're talking about a steady industry, where an example that Hari mentioned, banking, is where people don't really talk about banking as a growth industry. It's a steady industry that everyone needs. There's less fierce competition as it is the case in the growth industry, and that's where we are at now. Hari's talking about the steady industry and contrasting that steady industry with growth industry.
Yeah, and I think what I would say with those two things is that you have to look at it from the perspective of there are companies that are in the industry as a whole. There are maybe companies that are moving into these places. So a company may have some aspect of it, like banks moved over to doing business online, right? And so that may be a growth area for that business. But as a whole, that industry is pretty stayed as far as it doesn't have a lot of runway. Now, then you contrast that with declining businesses, or declining industries. And you can think about it like these are industries that are actually shrinking over time, and they don't have a lot of these were tried and true players back in the day, and now they don't have that. So one of the classic examples is the whale oil industry back in
whale oil.
Yeah, so in the early 1800s, late 1800s, early 1900s. And so this was what people used for lubrication, for industrial use, heating, all of these various use. Whaling was the big player. But what happened was, over time it got replaced by other lubricants that were created out of petroleum products. Yeah. It wasn't as dangerous to go overfish the
whale population.
The whale population. Yeah. And so what happened is, as these things started declining, there was still usage of whale oil in various applications. But as that industry shrunk, people were switching into what was considered the growth industry at the time, which was petroleum products. And so why that's interesting is that people make this assumption that as soon as people that's not the future of whatever, right? Everybody talks about brick and mortar stores. That's not the future of retail. Well, when you consider that it's still 80% of retail, it's still a very massive market. Now, it may be in the stable to declining phase, but that doesn't mean you can't make a lot of money if you are a brick and mortar retailer. And if you look at Amazon and these other places, they're actually trying to open up stores, physical stores, to make, to get into the brick and mortar space. And so, this competition is shaking up the industry, but it's also meaning that some other players may actually start, changing their business model. A lot of the brick and mortar are now selling online, and a lot of the online places are trying to open up, stores in the brick and mortar space. So, things can change, over time, and that change means that a company that was declining at one time can actually move into a growth phase, or into a growth industry or a steady industry, and big players may change their tune to get into a different market space. So whenever you start thinking about these industries, the declining businesses may have a lot of cash, may have a lot of built up money that they can go in and start attacking different areas. They can try and fight back and say, hey, my business is declining, but I can go into other things. So one of those is like oil and gas companies have a lot of investment in in energy, in alternative energy, so in solar power, wind, all of that stuff. So they're trying to get into these newer growth industries. So when you start looking at this stuff, you have to start analyzing it not from the perspective of just the industry, but also what is the company doing to kind of combat some of this stuff. And I'll tell you, as a value investor, the growth industries tend to carry a price premium, so we don't always look in that space. That doesn't mean we won't, but it's these steady industries that have and declining industries where you can find some things that are trading for a lot cheaper than they're actually worth. And so they can be interesting.
Right. So there's a lot to unpack there. right? So we talked about growth industry, steady industry, and declining industries, and how these these different marketplaces have different defining characteristics and features. But if you look underneath the hood, even within the marketplace, you have banking industries that's going into internet banking. Banking as a whole is a steady industry, but internet banking may be more of a growth story. So underneath the hood, it's not so black and white as just classifying companies into one bucket or the other. It can be fluid. And another thing that Hari talked about, which is very important, is the dynamicism of the company. This is what we talked about from episode number 1. We talked about why company is important to invest in. Why is it a good vehicle? It's because companies can move around and adjust, right? So as Hari talked about, you have this giant conglomerates. Let's say, for example, railroad, oil and gas. They're in the declining industry, but yet, they are a company, so they are able to be dynamic, and therefore they're able to deploy their capital to the growth industries, to the new growth engine, be it renewable or be it whatever it may be. They're able to do that, and so very important concept to touch on there. I want to come back. I want to touch on the the life cycle of business. The life cycle of a business. We talked about in the introduction that companies, just like any other living organism, go through a life cycle. They get, they're born, they grow up, they mature, and then they, phase out and die, right? And so different life cycles, and I want to get Hari's input on that life cycle and how it relates to investment thought process.
Yeah, I think, Becco and I work for a startup, so we are in the launch to growth phase kind of a business, right? And that's where, a company is cash constrained. They may not have the cash to, they're not generating cash, so they're really burning money. And in order to support their growth, any profits that they have, they're going to plow back into the business in order to, to promote the growth and, increase the growth of the business. And then they get to a point where they're able to generate enough cash that they don't need it all for growth. And, and that starts when, there's this classic, picture. It looks, as a physician, I always think about it as bacteria, right? It looks like an S, and it starts low, it goes up, and then it goes flat again. And so that growth phase is when that line going up, that you see. And then when you hit that maturity phase is when, the company really can't grow because they've tapped out all of their market, and so, you think about a business that is basically everywhere, right? So 30 years ago, McDonald's wasn't in every country, right? And so they were able to continue to grow. And some companies have hundreds of years of growth, right? And they're able to continue to grow, and they generate tons and tons of money. And then what they do with that money is they go and buy new businesses, and then they try and grow those businesses. And, sometimes they can do that very successfully and continue to expand their existing businesses out. And then there are other businesses that you could make the argument are in decline, because, if you look at the, Sears, which was, I think was 1800, late 1800s was founded, and Sears was basically the Amazon of the, they sold everything, right? You could go into a Sears, they had a catalog where you could find everything that you wanted, and they would mail it order to you. And then they started opening up the brick and mortar space. They had started making spent a lot of money into this growth phase. Then they hit a point where they had, there was a Sears in every city, in every town. There was a catalog store in every place. So you could find a Sears everywhere you went. And then what happened was they started putting money into other businesses. So Sears had, surprisingly, Sears owned Allstate, the insurance company. They owned a bunch of businesses that you probably never knew that they had. And they eventually divested themselves of all of these industries, and are now at a point where they don't, they're in decline. They don't make enough money to support their existing businesses. They're shutting down stores and so on. And some businesses may never decline. I mean, they may just stay in this mature phase. Some may stay in a growth phase for a while, and they may continue to find new avenues of growth. So, just like human beings, some people live till they're 20 years old and some people live to 100. Businesses have different lifespans depending on the industry they're in, the savviness of the people who run the business, who are able to find new areas to put their money into. And so you have to really start thinking about this as an owner. I buy stock in a company. I'm a piece owner of this business. I have to think about it. Where am I in this business? Where am I going to deploy my money if I'm the owner of this business to continue growth, to expand, the amount of money that I make for my shareholders, and that may be finding new industries that are either in growth state, steady state, or declining. But we need to all get that's part of this whole process, is really just understanding the business that you're operating in, because that's how you make good decisions about investing.
Right. Yeah. So just quickly recapping the life cycle of a business. Previously we talked about different marketplace. Also industries, synonym, marketplace industry. Industry, we talked about growth industry, steady industry, declining industry. But this is a really important point I want to point out. Industry and business life cycle are separate things. Industry and business cycle is different things. So industry, growth industry, steady industry, declining industry, life cycle of a business, launch, growth, mature, declining. There's two separate places, two separate ideas. So a company can be in a declining phase, but still can play in the growth industry or steady industry or declining industry. So that two different concept is very important to nail, and I want to convey this concept to you guys. And Hari talked about how different types of growth phases or phases in the business, from launch to growth to maturity and declining. Sears was a great example. As the Sears was ramping up, it drew this S shape, and then it's now in the declining shape. So if you think about a bell curve, almost, it kind of looks like that. And he talked about how the longevity of a company depends on a few different things. Depends on the marketplace, depends on people who run the place. So that's also important to realize as an investor looking into companies. So why don't we do a quick exercise? I think a couple episodes ago we talked about launching Hot Dog Inc. And we did that because we wanted us and you guys, listeners, to be able to think critically about a company. And the best way to do that is by starting a company on our own, thinking as if we're starting a company. So Hot Dog Inc. As we were opening up new stores in New York City, I think that was our location. What type of industry are we in, and what type of phase in the business are we in?
Yeah, so when you open up that first hot dog stand, right? We talked about how you raised money, and you borrowed debt, you raised money from your friends and family. That's sold shares in the company as equity. And so here you're now in this, you have this one hot dog store, right? You're in this launch phase, and now you have to decide, do I want to grow my business into a franchise or an industry, like that has hundreds of stores and, generates profit at every store, and I get, collect money off of that. And how do you grow this? So obviously we're in the restaurant industry, right? And there are subsegments of every industry that may be, fast food, or fast casual is another concept, that people talk about. But the restaurant business is a steady industry, right? It is not really declining, it's not really growing, and as a hot dog store, there's a lot of competition, especially in New York City. There are hot dog stands, there are other things that compete for my attention. We can make the argument that if you like hot dogs, you may like burgers also. Those, I have to make a decision when I buy a hot dog whether or not I'm going to buy a burger also. And so all of that, there's lots of street food, that also competes with it. So I can grow my business by launching, new stores. I can grow my business by having more people come to my store, right? So I can spend money on marketing to get more people, right? But typically, I'm not going to drive, 40 blocks just to go get a hot dog, right? So it makes more sense for me to have stores in convenient locations so that people are walking by, they see it, they can stop and get a hot dog, right? So the growth is going to come in by putting in, outputting more stores. And so, that's where we are right now with the hot dog, store, is that we're trying to think about, this growth. And as an owner, right, what I may realize is that, this concept works in the city of Manhattan, in Manhattan, but it doesn't necessarily work in,
say Houston.
Yeah, Philadelphia or, somewhere else, right? So I may have to change, I may need to have brick and mortar stores. I may need to have, do I want to have Uber delivery, come and pick up my food and drop it off via Uber Eats? How do I want to have, that kind of setup, right? Maybe I want to have a deal with the New York Yankees where I sell, hot dogs, right? But obviously, if I'm going to do all of that, I need to get to a certain point where my name brand is recognizable and I have enough money to support this, right? And so, the first step may be to start growing just by opening up new stores, right? And so that's kind of where you have to think about this. The restaurant industry is going to is a very tough business, right? And typically what happens in the restaurant business is the first 5 to 10 years is when a business, can grow really quickly. And then people kind of get tired of the food and then they move over to something else, right? There are some exceptions to this, obviously, but, so you have to think about it. How long is this runway for this business? And, there are lots of restaurant chains that have shut down over time just because, people just stopped going and so on. So, what do I want to do with my, the money that I have and the profit that I generate? Should I go get more debt, raise more money through equity? And so these are all of, the kind of things, that you have to think about as you go through it.
Right. Yeah. So the Hot Dog Inc. We're obviously in a launch and growth phase, and Hari talked about different ways to start hot dog. How to market yourself, what to do when you're in a launch phase, especially in this restaurant industry. And the restaurant industry as a whole is, it's in a steady industry. It's never going to decline. It's in a steady industry, but it's not a growth industry again.
Yep.
And so finding innovative ways to really, get yourself started is a very important thing. And this idea of analyzing Hot Dog Inc. again is just like analyzing any other companies. Say you pick a restaurant chain that's being publicly traded in NASDAQ. What you do is basically what you just did. You think about, okay, this is a restaurant business. How are they growing? How are they, the retained earning? How are they supporting their business as they move forward? Are they continuing to plow money into growth, or what does it look like? So these are types of questions that you have to answer for yourself as an investor. And to be a good investor, you should do this. So that's it. The market analysis. We talked about different types of industry, growth, steady, declining. We talked about life cycle of business as a separate concept than industries, different types of industries. We talked about launch, growth, mature, declining, the S-shape of a life cycle of a business. And we went through the exercise of Hot Dog Inc. and how it relates to two different concepts we talked about there, the marketplace and the life cycle of business. Very, very important to nail down. So, well, thank you all for joining us in this episode, episode number 7, Market Analysis. And if you liked our episode, please subscribe to our channel on YouTube or any other podcast app that you listen to. It'll help us a lot. And leave us comments. We would be happy to chat with you guys, correspond with you guys in the chat box. So thank you. Join us on the next episode. Thanks.
Thank you.